Hello everybody, today I will read an article which is called Notes on Public Debt and Financial Speculation. After a few years of relative quiet, in recent weeks, the issue of the sustainability of Italian public debt has returned to current affairs. We resume talking about the famous spread, which by now, in the Italian common imagery, is associated with the figure of Mario Monti and his government Tears and Blood, which took us out of the financial storm of 2011. And there is again a talk of the risk of bankruptcy, also called default, and of the concern that the European Union expresses for the government's financial policies. Among the articles written so far, this is likely to be the last original, because it incorporates data and considerations widely known to those who had the curiosity to deepen the issue of public funding of states. Yet there are some good reasons to write it. One of these is that, especially in the progressive field, banalizations, slogans, simplistic formulas, and vagueness on the subject proliferate. And this is all the more serious for two reasons. The first is that public finance mechanisms have direct repercussions in everyday life, and it is therefore desirable that as many citizens as possible know them. The second is that the lack of clarity has only helped all those political forces, especially the populists, who cry out to sensational plots and advance the most bizarre theses in financial matters. Among the champions of simplifications and vagueness, there is, I'm sorry to say it, my party, the Democratic Party. More or less consciously, the major opposition party has decided to assign to itself the quality of responsibility for managing public accounts, and to depict government forces as unreliable and spendthrift. In this case, the Democratic Party accused the government of having approved a budget that exposes us too much and therefore of jeopardizing future generations. A similar attitude makes it all the more smiley if you think that in the 5-year period from 2013 to March 2018, the years of the PD governments, the public debt has gone from 2,070 billion to 2,300 billion euros. That is, it has increased by more than 200 billion or 10%. And the deficit GDP ratio has never been less than 2.3%. A slightly stronger sense of reality should advise the PD representatives to criticize the yellow-green government's economic budgets with argument other than over-indebtedness, but for example, on nature and usefulness of spending choices. Having said that, nobody wants to deny that Italy is rather fragile in the financial markets, or that it is necessary to deal with the sustainability of the debt. With this article, I simply wanted to do two things. The first is debunking two clichés about Italian public debt. The second is to explain a perverse mechanism of finance, one of the many that forces states like Italy to move very cautiously and to have extremely limited margins of economic policy. Let's start. First cliché. We Italians live above our possibilities and therefore debt grows constantly. It's not true. From 1992 to the present day, with the sole exception of 2009, the Italian primary balance has always been positive. In other words, the revenue was higher than the outputs. The state has spent less than it has cashed. Unfortunately, because of the interest expense, namely interest on the debt, the total balance has always been negative, so we have increased the debt. Just to give a figure, in 2017, Italy has spent 67 billion to repay the interest on the debt, roughly 8% of total expenditure. Second cliché. A high public debt like the Italian one is not sustainable. It is a threat to the financial stability of the country. False. Today, Italy is a debt debt GDP ratio of 132%, a figure that is commonly referred to as the main cause of its market vulnerability. For this, it is said, we pay $146 million a day of interest on the debt. But to refute this simple fact, there is Japan, a country that has never suffered any pressure for the financial markets and boasts a much higher debt GDP ratio than the Italian, a phantasmagorical 253%. Despite the fact that the Japanese debt is 4 times the Italian, the interest on the debt amounts to $13 million a day, so just a tenth in absolute terms. How can this be explained? The answer is simple. It is not so much the amount of debt that constitutes a problem to the sustainability of the same, but rather its nature, its composition. And actually, it turns out that the compositions of the two debts are very different from each other. Japanese debt is held at 70% by the Central Bank of Japan, the Bank of Japan, 22% from Japanese trust and investment funds, therefore also small and medium investors, and less than 7% is in the hands of foreign investors, especially banks. In the case of Italy, but one could say the same thing for European countries like Greece and Spain, the situation is very different. 32% is in the hands of foreign investors, 27% to banks, especially Italian, 19% to insurance funds, 16% to the Bank of Italy, and finally only 5% to small and medium Italian investors. All this let us therefore think that if Japan pays so low interest compared to Italy, even if it has a much heavier debt, the reason is that its creditors, that is, the central bank and the internal investors, are very little demanding, and that they are content with low interest rates. It's not the same thing for Italy. The creditors of our country are, for the most part, large national and foreign financial institutions that see in government bonds a way like any other to make money, to make speculation, and they are therefore more demanding. Financial markets actually demand higher returns than investors or institutions that want to buy securities simply to protect savings from the devaluation of inflation. Today, so to speak, an Italian government bond with a 10-year maturity has a yield of 3.31%, whatever that means, while the Japanese counterpart has a yield of 0.13%, well below that of the very secure Germany, 0.45%. Yet, it has not always been so for the composition of Italian debt. Up until the 80s, the composition of the debt was very different. In 1988, the data are taken from an article of Repubblica, who holds the Italian public debt evaluation in 30 years, the portion of the public debt in the hands of foreign investors was just 4% of the total, while the banks and insurance funds held 25%, and Italian small investors dominated the market with 57%. However, it must be remembered that for the finances of the state and for economy in general, the late 80s and early 90s were not particularly happy. Indeed, in many respects, they were crazy years. Growth was shaky, the inflation, that is, depreciation of money, ranged between 5 and 12% each year. The deficit GDP ratios were regularly double-digit, and the liabilities on interest were very high. In fact, the interest rates were decidedly high. The annual BOTs, ordinary treasury bills, or bonds, better, also reached 10% interest, and many Italian savers used to buy them in order to protect themselves from inflation that risked eroding the value of their earnings. But the point is that at the time, the responsibility for the sustainability of the public debt fell almost entirely within the national borders, and therefore any debt crisis would not have generated negative repercussions for foreign countries and economies, as it would happen today for Japan in the event of a debt crisis. On the other hand, then, the government had full autonomy in the choices of fiscal matters, and there was no fear neither of markets nor of spread. At the time, there were not even promotions or rejection by the European Union, which succeeds in imposing sometimes irrational economic policies, such as austerity during the years of crisis, years in which there was need of expansive rather than depressive policies. Today, interest rates on the Italian debt are lower than 30 years ago, that's true. But from a financial point of view, Italy is paradoxically more vulnerable and blackmailed. It is enough that an economic measure gives the least suspicion to the market that suddenly the spread, the difference in yield compared to German bonds, sketches to unsustainable levels, putting the public accounts at serious risk. Common sense, therefore, would require gradually changing the nature of public debt by encouraging small and medium Italian investors to buy bonds and increasingly restrict BTP sales to large financial institutions. Therefore, progressively move from the current internationalization of the debt to the nationalization of the debt. But this must be made on one condition, namely that of maintaining a virtuous spending policy, as it has been the case in Italy since 1992, avoiding the senseless expenses of the 70s and 80s, which are at the origin of the vicious circle of the Italian public debt. In other words, it would be advisable to copy at least some features of the Japanese management of the public debt. And now, after demonstrating that two widespread convictions are actually too cliché, and I hope I did it without the sensationalist tones of conspiracy or nostalgia for a happy past that never existed, it's time to explain a perverse mechanism of current finance. Why? The reason is that an effective way to understand the extent to which financial speculation can be absurd and counterproductive for the real economy is to know the functioning of at least one financial instrument currently in use, a tool that negatively affects the yield of bonds. And to do so, my choice fell on the notorious CDS, credit default swap. Let's start by saying that CDS have been called financial weapons of mass destruction by Warren Buffett, not exactly an anti-capitalist activist, but one of the greatest Wall Street investors of all time. The CDS were born in the 90s and belong to the category of derivatives. That's it, securities that derive their value from other securities. The derivatives have been, and are still now, at the center of a very heated debate, especially in the United States, because they would be, at least partly, responsible for the 2008 financial crisis, which then hit Europe, causing the disaster that we know. Yes, but what exactly are these CDS? It is about contracts of insurance on the debt, or better, on the solvency of a subject issuing bonds or securities. Have you bought any bonds issued by Greece and you're afraid that it will declare bankruptcy and therefore not return the money that you've invested? Well, then you can assure yourself. Sign a CDS contract with an investment bank. The contract can have a duration of 1, 3, 5 or 10 years, you decide. You also decide how much you want to insure. Let's say you have 100 million euros of Greek debt and you want to insure them. You subscribe a CDS and commit yourself to paying the insurance premium each year. If nothing happens, you pay the insurance year by year. If Greece declares bankruptcy or insolvency, then the insurance bank gives you the money you were insured for. How much does a CDS premium cost? It depends on the risk of related default. It is usually expressed in base points. 100 base points equals to 1%. Therefore, if the risk on certain bonds is 100 basis points, BPT, the insured person will have to pay each year 1% of the sum for which he has insured. In the most tragic years of the Greek debt situation, 2010-2011, the insurance premium had reached the astronomical figure of 2,000 BPT, or 20%. This means that at the time, those who held CDS to secure, let's say, 100 million euros of Greek debt, had to pay 20 million a year to the insurer. Yes, I understand, someone could argue, but where is the problem if you're insuring against a risk? Well, first of all, we must say that CDS market is very opaque. We do not know exactly how much they are worth in total, who buys them, and how they are exchanged. They are part of the so-called over-the-counter OTC, that is, securities which are not exchanged in the stock markets. The second problem is that it is not clear how the risk of a bond is calculated. But there is more. To buy a CDS, in fact, it could be an investor who does not hold any bonds insured. That means that there are investors who buy CDS hoping that the company or the state declare bankruptcy in order to collect the sum insured. It follows that those who speculate in CDS will do everything in their power to make state or company declare bankruptcy. But probably the most dangerous CDS speculators are not those who buy them, but those who emit them. An institution that issues CDS on a country's debt will also have every interest in putting it under financial pressure in order to be able to claim higher insurance premiums each year. There are many ways to increase a country's default risk, I guess. The most obvious is to buy government bonds and then sell them off. This operation, if massive and well orchestrated, is able to generate a chain effect. Other investors sell those securities for fear that they lose value. The devaluation of securities requires the issuing country to increase interest to make them more attractive, exposing so itself more to insolvency risk. And so a dangerous vicious circle can arise, which has the effect of raising the CDS premiums. To understand the magnitude of the sums involved, just remember that in the article Time to Wipe Out the Absurd Credit Default Swap Market, John Dysart, columnist of the Financial Times, estimates that in 2013 the notional value of CDS was not less than $25 trillion, almost twice the GDP of the European Union, and fell to the no less disturbing figure of $10 trillion in 2018. Well, it's time to draw conclusions. What has been said about CDS certainly does not claim to be exhaustive, but rather had the ambition to clarify the speculative mechanisms currently in force. Whether we are progressive or conservative, since such financial instruments benefits only a small portion of the population and succeed in provoking profound crisis in the real economy, it would be really desirable to ban them as soon as possible. Is that utopia? Yes, it may be, but the front of those of who has opinion, have this opinion, is more transversal than one might expect. In America, for example, it ranges from the Occupy movement with its motto "We are the 99%" to the members of the financial world, including Warren Buffett himself, who has pronounced himself several times for the dismantling of the derivatives market. In short, the battle for ethical finance could easily enter the political agenda of any party. Indeed, it should. Okay, thank you very much. See you next time. Ciao.